I'll teach you something about cash flow. So we said the biggest difference when you're looking at net income, you would have net income, right? You add depreciation, you go plus and minus various other current assets and current liabilities, and then you wind up with cash flows from operations. Okay. So when I was a young man, when I was a kid, we'd go visit my grandmother in Florida. This is all personal story today, but it's all related to accounting, trust me. And Grandma lived in Florida, and she was like on the frontier. I don't know if anyone's familiar with South Florida, but she was like on the frontier. And behind her house, there was a canal, and then it was almost like the Everglades there. And I still remember this as a kid because it was the most bizarre thing, is that we'd be driving someplace, and we'd be driving down a road, and there's nothing there, absolutely nothing. There's just a road. And then you come to an intersection, and no one lived there. There was nothing there. And you come to a big intersection, and if anyone here has been to South Florida, they kind of know what the roads are like. And on all four corners of the intersection, there would be a gigantic shopping center. All four corners. Huge shopping centers on all four corners of every intersection. And then typically there'd be like a fast food restaurant or two over here. There'd be a gas station on all the corners, and there was all this building activity right on the intersections. Usually all four, there'd be gigantic shopping centers, typically with anywhere from 20 to 40 stores. Most of the stores were empty and no cars. That was it. And you drive down the road, and then you come to one, and they're building more. They're building more shopping centers. No one lives there. There's no customers. No one is near there. And they keep building more shopping centers. So the story was like this. This is the early 1980s, late 70s, 80s. The story was like this. There was an accounting rule. It said that if you're losing money on an investment, you can deduct it on your taxes. It's very nice, right? So if you have, let's say you have a shopping center. You invest in a shopping center, and let's say that, and it's empty. It's a money loser. So you take out loans. Let's say you borrow $10 million for the whole thing. And interest rates then were pretty high. So let's say interest rates were 12%. What happened to the one? Do you see it just disappeared right off the screen? Isn't that cool? Oh man, now there's this little, okay, there we go. This would amount to $1.2 million interest a year. And you use it to build a shopping center. So you have a $10 million shopping center, let's say, and it's depreciable. Let's say that it has a 20-year life. That means that you would have $500,000 a year in depreciation. Follow me so far? And you find tenants for some of the shopping center, but it's not enough. So let's say that your annual rent on the shopping center is $2 million a year. Now let's make it even less, just to be fun. From this, you have interest of $1,200,000, and you also have depreciation of $500,000, and then you have maintenance of $500,000. So then your shopping center is losing wait, this has up to 2.2 million, right? Minus 1 million. Your shopping center is losing 1,200,000 a year. Follow? So the IRS rules are that you can deduct that from your taxes. So the thing is that you don't buy the whole shopping center. Let's say you buy a 10% share in the shopping center. So what you can do is you can deduct this on your tax return. $120,000 loss, immediate deduction. Now let's say you had $200,000 in income on your tax return. Then you would deduct this, and then you would only have $80,000 in income. Let's say that you had a bad year. Let's say you had a bad year, and you only made $100,000 in income. Then you would have a $20,000 loss on your tax return. Now the tax law says that if you have a net operating loss, it's called an NOL. If you have a net operating loss on your tax return, the IRS will refund your taxes that you paid in a prior year. So you will actually get money back from the IRS. Isn't that nice? Let's just show them. Oh, there we go. See here? So this here, you would have a $20,000 loss showing on your tax return, and you might as well deduct, all your other expenses. And you have a $20,000 loss now on your tax return. The IRS will refund your taxes you paid last year, and you'll get money back from the IRS. Isn't that nice? So you not only don't pay any taxes, because you have a 10% share in the shopping center, you not only don't have to pay any taxes, but you'll get taxes back from previous years. Everyone follow me so far? So, meanwhile, you may ask, how is this shopping center still going? Right? Because if you start a business and you have $1 million you invest, and the business loses $1,200,000, your real estate business loses $1,200,000, what are you going to do? It's going to go out of business. Well, you as the investor don't care. How much money did you invest in this? You invested, presumably, maybe you invested $50,000 for your 10% share of the shopping center. Maybe you invested $50,000. You already saved $50,000 in taxes. Isn't that beautiful? You got your investment back, not from the shopping center, but in your tax savings. And every year the shopping center loses more money, you save more money on your taxes. Isn't that beautiful? So if the shopping center loses money next year, well, that's a really great thing, because now you can deduct that on your taxes again. So you don't have to pay any taxes. Yes?
But isn't that kind of counterproductive? Like, if you're losing money, yeah, at the same time, you get like a deduction.
When you make money, you pay taxes, right?
Yeah.
When you lose money, isn't it fair that you shouldn't have to pay taxes, or you should get tax money back?
I guess, but won't that cancel it out?
Yeah, of course it does. It's only fair. Right? When I have income, then Uncle Sam's my partner. I have income, I pay a third of it to the IRS. If I had a loss, then the IRS should pay its share of the loss. It makes perfect sense. They should give me back some of the tax money I paid previously. So, but wait, this shopping center is going to sooner or later run out of money. So what do? There's two things you can do. One thing is attract more investors, because it's a good deal to be invested in this. You get great tax savings. Or call the bank, because you owe this $1.2 million. Call them up and say, look, we're not making any money on the shopping center yet. We can't make the interest payments. Can we take out a new loan? Let's refinance the loan. So the bank has no choice. The bank is going to have to do that, because they don't want to foreclose on a shopping center that's worthless in the middle of nowhere, right? So what the bank will do, plus, considering that the developer is on the board of directors of the bank will really be very flexible with you. So what the bank does is the bank is like, okay, fine, let's just finance the interest for now until you're more profitable. So what you can actually do here is, if you can get the bank This is the cool part of it. You get the bank. This is income, right? Let's look at cash flows for a second. You have $1 million in income, rental revenue, and the bank agrees that you don't have to pay interest yet. You can finance the interest. Then you have depreciation. Do you have to pay depreciation? No. The only thing you have to pay for are the maintenance costs, which is $500,000. So therefore, the actual cash flows from operations for your shopping center are, get this is pretty funny, positive. You own a 10% share in the shopping center, so they mail you a check for $50,000. That's your share of the cash flow this year. So follow me, because you can't make this stuff up. So you, as a 10% investor in the shopping center, get $50,000 back as a return on your investment. Your share of the profits, not really your share of the, it's called liquidating dividend. It's perfectly fine. Then, on paper, you have a $1.2 million loss. 10% of which is yours. So you receive $50,000 in the shopping center, and at the same time you deduct a $120,000 loss on your share of the loss. So the only thing that could make this any better, right, it's not enough to get a really nice tax deduction, it's getting a little cash back from the investment.
That sounds like something very exploitable.
Oh yeah. So as you're driving down the road in Florida, right, people are building shopping centers all over the place where there's no hope. When you're running a business like this, do you want people to move in and the shopping center become profitable? That's the worst thing that could possibly happen. You might have to pay taxes. But you can't lose there, because what could happen then? Look at this situation. It loses so much money that it gets foreclosed on the bank. You're a limited partner. You're not liable at all. The most you can lose is your investment. You've already made back your investment in tax savings. So that's not a problem at all. Take the other side. So there's no downside risk from this. Very little downside risk. The only risk is you can't take advantage of the tax deduction. The upside risk is that 20 years from now, people will live there and the shopping center will actually be profitable and you make some money on it. That could happen too. So here you see the depreciation and the difference between cash flows. And by the way, this was with shopping centers, especially in Florida and Arizona. The reason why they were in Florida, Arizona, Texas was because the banking rules, they were very flexible. So banks funded a lot of this kind of activity. I learned about it because later on when I got a little older, my first job in accounting, I was actually worked for an accounting firm that did a lot of these. So I saw a lot of them inside. So this was shopping centers and office buildings in Florida, Texas, Arizona were common states where a lot of this activity was going on because the banks there were very flexible. You had major collapse of banks in the mid to later 1980s, mainly because of this. So you had a number of major bank failures because the bank loan, their loan portfolio consisted mostly of shopping centers and office buildings that were completely worthless. So you can only loan them so much money and bail them out for so many years until the federal government figures out what you're doing and then closes you down. So the Tax Reform Act of 1985, and then later there's an 86, try 86, Tax Reform Act 86, said that you cannot lose more money than you invest. Duh, right? That's what the rule says. It says you cannot lose more money than you invest unless you're going to have you're something called at-risk rules. That completely did away with this. So suddenly the shopping centers couldn't raise more money. Investors had to go elsewhere, and a lot of these things all got foreclosed on and closed. There was one other thing. Oh yeah, and there was in Texas. This was pretty cool. Texas was wilder than Florida because Texas had the oil boom in the early 80s. So there was lots of money being made. And when there's money, there's people who are looking to save money on taxes. So they were building all these skyscrapers in Houston and Dallas. And but there weren't companies to occupy them. But they don't need companies, right? Because what you would I mean, they weren't building these things to be profitable. They were building them to lose money. Because if you lose, the more money you lose, the more you can deduct. So in Houston and Dallas at the time, they had this phenomenon. They call it the see-through skyscraper. And what it is a glass tower with nobody inside. Literally nobody inside because they can't find any tenants. Completely empty buildings. And they were building one after another because the tax incentive to do so was so strong. So again, this was eliminated in 1986. Yeah, David.
Yeah, but isn't that something that China's kind of doing now? Because like you have like entire cities or apartment blocks not inhabited.
The tax laws today are completely different, and they don't encourage this kind of activity. So when it's capital, what?
This won't work for that.
It won't work like it did then. There's still ways to do it, but they're much riskier. Today you can't do it unless you take on some risk of losing money. So if you were to be allowed to do this, then you would have to allow the bank to come back to you to recover the losses. That would be the difference. So if you, in this deal, you're protected from the losses. If the bank forecloses on the property, it says, look, you guys have a $10 million shopping center here, and we've loaned you $25 million. We want our $15 million back. In the old days, the bank couldn't get it. In the new days, if you were to construct a deal like this, if you were a general partner who took responsibility or guaranteed the debt of the bank, then you'd be allowed to deduct the money. But the bank would be allowed to come after you for the losses later on. So this here was risk-free. This was very nice. The way you would have to construct a deal like this today, you would have to accept a lot of risk, which most people wouldn't want to do. It probably wouldn't be worth it today. But the other difference was that then marginal tax rates could go as high as 70, I think, or even 80%. So if you had a tax rate of, if you were in a high income bracket and you're making $800,000 or $1 million a year, and you're in a tax bracket where you make it paying 70, 80% taxes on your income, then you would want to do something like this because you don't want to pay, you don't want to pay 70% of your taxes, 70% tax rate. That's absurd. So what they did in the Tax Reform Act of '86 was they lowered the tax rates down to a maximum. I think at the time it was a maximum of 34%. They've raised them since then. So they did the two things at the same time. They lowered the tax brackets significantly, but they eliminated a lot of the deals that people used to be able to do. Yeah, I forgot that. It's the high tax rates at the time, where tax rates in the early 80s were absurdly high compared to what we have today. All right, great. So I thought I'd share that with you. And that just shows you how depreciation